Did you know that no real money is lent when borrowing money from an institution? Hello, today is August 19th, 2021, and the time is 8:26 a.m. So while I wait, and I do have time now while I wait to be able to afford to continue my travel, and again, thank you to everyone who's helped me so far. Really appreciate it, and my journey's not over, and I'm unfortunately going to need help to get to the destination in my life where I would like to be. And anyway, so over the months, I know people have asked me to address a specific topic, and actually yesterday someone had really stressed, you got to do a video on this topic, you got to do a video on this topic, you know, people need to know. So over the past 10 years, I made videos about this specific topic that I'm going to address now, as well as other topics. And I know there's a lot of people new to my channel or coming across me in other platforms, and you know, they're not going to go through 700-800 videos to find out everything that I've said. And most of my videos are not public anymore, because I try to keep only the videos up that I think, for example, when it comes to exposing and whistleblowing, the sex trafficking, the police, judicial, political corruption, etc. I try to keep the videos up that I think best tell that story, that's not like 2 hours long. So I'm going to be talking about banking. Ooh, banking. And banking is money. Money is what I'm waiting for right now so I can continue my journey to rebuild my life. So what about banking? Now, I've talked about in the past about fiat currency, what that is, and I've talked about even, it was about 3-4 months ago, a video on this crypto digital currency, and that's basically fiat currency on steroids and the scam that it is. So go find that video. I'm not going to be talking about the money origins or anything else, but specifically I want to focus on loans or credit granting. And there's two kinds, there's prime and subprime. And what I'm going to do real quick is give an analogy of what subprime lending is, so you can get an idea. So say, for example, you are a subprime lender. It could be private, or it could be like a bank, or it could be even, say, government. And we're going to use a bicycle, an old bicycle that has duct tape holding the seats. Now, can you picture that? You know, duct tape, and you know, the bicycle is just, but it works. You know, it runs. So you have this bicycle, and somebody needs that bicycle to, or they need a bicycle to move on with their lives, to find work, to get to work, whatever, transportation. The person has no money, they have no job, they have nothing. So you go in and say, listen, I'll give you a loan for that bicycle, and you pay it back. And the interest I've seen the interest as high as 49%. And I remember one time, one particular credit grantor I had as a client, 49%, and the courts were like, you know, no way, and they were defaulting to the Courts of Justice Act pre and post, and which wasn't even close. I think it was 4 and 6%, and I successfully argued 29%. Well, that's what it ended up being. I argued the 49, but I ended up getting the highest award. And it was cases like that that really put me on the map when I was at the peak of my career. But anyway, I digress. So the person gets the bicycle, and pretty quick they default. Now that bicycle is repossessed. That person who signed the contract to pay off that bicycle still owes that money. That default is insured. So the credit grantor, subprime credit grantor, is getting money for that default through their insurance. Plus there's government subsidies under a loss. Now I'm skimming through all this, being very general and trying to simplify it so people have a basic understanding. And you know, I mean, I can go in depth, but this would be like a 5-hour video and I still would be skimming through it. So that credit grantor, subprime credit grantor who repoed that bike has it insured, has government subsidies, and now is reselling that same bicycle and going through that same process over. And that is where money is made hand over fist, just through all that. And then you have when people default, whether it be prime or subprime. Now I just explained subprime. Prime would be somebody who just pays, you know, they make their payments, they have a job, they have assets, they have everything to get the loan, and they make their payments. And the banks are like, you're a really good customer, you know, we're going to up your access to loans, you know, raise your credit limit, whatever. And that's the bait. And most people are smart. They'll be like, oh, I'm not touching it. They keep upping it. And then it just takes one time. Well, I'm just going to dip it to, I need it right now. So, and then, but they pay it back. Maybe on the 10th time they can't. Maybe on the first time they can't. And then that's the catch. So that's basically prime and subprime lending and how that works. And even if you're dealing with a prime lender and you're that good customer and you default, that's where really big money's made, is on default. And then I'm just going to skim through third-party collections. So every credit grantor would have their own in-house collections, you know. And it starts off, they're really friendly, really, you know, oh, you missed the payment, you know, stuff like that. Then you get into 30, 60, 90, 120 collections, and then you get into third-party collections. And this is where, in the 2000s, my concept of revolutionizing the debt recovery world for using litigation came in. I'm not going to get into the whole explanation of it. Suing for debt is nothing new, but on a grand scale, say for example, I'll put it in perspective. Say on a pilot project, 10,000 files at $650 to get to judgment per file. Multiply that's a kind of a big number, and that's just to get to judgment. Using litigation, the advantage to litigation is it was like 90% of those claims ended up in default. So you got default judgment. Any judgment is good for 20 years, etc. And yeah, you basically own the person for the next 20 years. So anyway, and I'm not going to get into it. I think I talked about all that in another video. So they're trying to collect their money, and now we're dealing with third-party collections. And there's no contractual agreement between what's now called the debtor, the person who bore the money, who couldn't pay, who defaulted, and the third-party collection agency. And that's why a lot of people around the early 2000s were like, you know, I'm not paying you, I don't have to deal with you. And that's where they started to suffer. And I had come in just, you know, around that time and offered doing it through the courts. So there's a little bit about collection agencies. If you agree to engage them, then now you have contracted with them and you're stuck dealing with them. So just, you know, whatever. So there's prime, subprime lending, and how it really works and how money is really made, big money. That's where the big money is. Talked a little bit about the insurance part about that and them trying to collect from all that. And so hopefully this video, and I know I'm talking fast and I'm trying to get through it all really quick. I don't want to make this into a huge long video that, you know, people are just going to turn off anyway. I hope this answers your questions and gives you some more insight into how the money system works. Thank you for watching. Please like, subscribe, comment, and share. There's a thing called SCORE, that helps determine who they can collect money from.